Hello, everyone, and welcome to the group education for the Regal Wine Imports 401k plan. My name is Ashley Rosser, and I am with Victory Fiduciary Consulting, and we are the advisors to the 401k plan. And so this webinar is for anyone who may have missed our group education that we held last week in May of 2018. So we are an independent registered investment advisory firm. And so we specialize in providing 401k plan compliance and consulting to employees as well as plan trustees who are responsible to oversee the plans. And so we are the advisor, and so we're here to give you some education and insight to help you make good decisions regarding your 401k. The custodian is Mid-Atlantic Trust, and so that's the company who actually holds the assets. The record keeper is Turning Point Associates, and so that's the company who you get your quarterly statements from, and they provide you servicing if you need to take withdrawals at retirement or if you need to update any of the information regarding your account. Then the last part of this piece here is you. You are the manager and the ultimate decision maker of your account. Eligibility at Regal is 1 year of service, age 21 or older. Then you can enter in the first day of the following quarter. And so one of the things that Regal has instituted is a automatic enrollment, so that as soon as you are eligible, the first day of the next quarter, unless you opt out or choose a different percentage amount, you are automatically enrolled at 3%. And then you have the ability to opt out, and then also you have 90 days to decide if you want to get a refund for any of those automatic contributions that might have been put in. I'm going to talk to you in a couple minutes about why that 3% is important. I'm going to greatly encourage you to do a minimum of 3% when you originally enroll. And again, Regal is just trying to take the barriers out for you. They're trying to encourage you to enroll and to take full advantage of the plan that's available for you by doing this. The 401k is designed to help you prepare for retirement. Contributions are made with pre-tax dollars and then grow tax-deferred until you begin to take distributions. And so what that means is that if in last year you earned $30,000 and you contributed $2,000 to your 401k, you would have only been taxed on the remaining $28,000. There's also a Roth option within the 401k at Regal. So with the Roth, your paycheck is taxed first, and then any earnings in the account thereafter and withdrawals are taken tax-free. And so that's a really powerful tax incentive the longer you have until retirement. In order to get that tax-free income, the assets have to have been in the Roth for at least 5 years, and you have to be age 59 and a half or older when you begin to take distributions. The maximum that you can contribute to your 401k in 2018 is $18,500, and then if you're over the age of 50, you're given a catch-up provision and you're allowed to do a maximum of $24,000. Currently, there's an extremely important and lucrative match that Regal is offering employees, trying to incentivize you to take advantage of the 401k. Regal gives you 100% of the first 3% that you can contribute. Then they match another 50% of the next 2%. So you remember I told you that 3% was a big deal, because if you auto-enroll at 3%, Regal's going to give you an extra 3% on top of that just for contributing. But then if you do up to 5%, you're going to get another percent. So by doing 5%, Regal will give you 4%. So at a very minimum, I would greatly encourage you, everyone should be doing at least 5%. Otherwise, you're leaving money on the table that Regal's trying to give you for retirement. And again, this is a very, very excellent match that Regal's giving. They're really trying to help you prepare. They're very generous, and so I fully hope that you'll all take advantage of that. So this is designed for retirement. It's designed to not have withdrawals be taken from it unless you are 59 and a half or older. However, there may be some times where you might qualify to take a hardship withdrawal. Anytime there's a hardship withdrawal, you'll have to pay taxes and penalties if you're under the age of 59 and a half, and you will be suspended from making new contributions for 6 months. So it is really meant to be used only in extreme emergencies. And then these are some examples here that you may be able to qualify for a hardship withdrawal. Distribution. So when can you take money from your account? Obviously, at retirement, you will have access to 100% of your account. If you die, your beneficiary has access to 100% of your account. If you're deemed to be permanently disabled, then you may access your account. And then if you leave Regal, so if you no longer work for Regal, you will have access to 100% of the account balance. But if you're under the age of 59 and a half and you have a check sent to you and you cash it, then you're going to be paying taxes as well as a 10% penalty. So typically we recommend that if you leave Regal and you have a balance, it probably will make more sense for you to roll it over either into an IRA or into a new 401k plan rather than just taking a taxable distribution. You may also have other IRAs or 401ks just kind of floating around out there that you want to roll over into the 401k at Regal. A lot of times participants find it easier to only have one account to manage as opposed to having multiples. So if you're eligible to participate and you are enrolled, then you do have the ability to roll over your 401k or IRAs over to your new plan. So if you have questions, I'll make sure you have my contact information at the end of this call. Reach out to me and I'll give you the information for that. You can change how much you're contributing quarterly. Today you'll also have the opportunity to make a change, and I'm going to encourage everyone to try to go up by 1% more. You can change your investment positions at any time, so how you're invested. You can change your beneficiary at any time. However, if you're legally married and your spouse has not signed off on a waiver, your spouse must be your primary beneficiary. So everyone should have received information which has primary beneficiary fraud disclosure form, as well as our Schedule A, which is our annual required disclosure. And so that primary beneficiary form states that if you've named someone else other than your primary spouse as beneficiary and they've not signed off on that waiver, then you've committed fraud. So it's very important for you to know who you've named. If you're not sure, you can call Turning Point and they can let you know. So we know that deciding to enroll in a retirement plan will be the most important decision that an employee can make. If you're middle management and above, 80% of the money that you'll have at retirement is going to come from your retirement plan. And if you're below middle management, 95% of the assets that you will have at retirement will come from a company retirement plan. So average annual retirement income. Back in 2016, for women, it was $16,300. Men were not much better at $29,300. And so what this tells us is that Americans are grossly underpreparing and underfunding for retirement. Part of the reason that we know that there really is never a good time, that no matter where you are in the life cycle, there's always going to be distractions, whether you're raising kids, trying to save up money for a house, trying to pay off credit cards, maybe you have weddings that you're paying for. Unfortunately, sometimes people get divorced and that can be expensive. People get sick and now they can't work as much as they were working before. And unfortunately, the reality is that in America, every day Americans wake up with the realization that they're never going to be able to retire because they never got started. So here we're going to talk about the power of getting started as soon as possible. Emily and Dave both decide that they're going to contribute $200 a month. Emily just decided to get started at age 25, and Dave decided just to wait 10 more years until 35. So over Emily's lifetime, she contributed $96,000 of her own money. Dave contributed $72,000. It doesn't seem like that big of a difference, but when you look at the power of compounding interest, at 65, Emily had $400,000 and Dave only had $200,000. So those 10 years were actually a really big deal. And then another point that I want to make is imagine if Emily had decided to contribute $200 to a Roth instead of the traditional. She would have contributed $96,000 of after-tax money, and at 65 would have been able to take $400,000 tax-free. So that's where the power can really be. So for success, decide how much you're going to need to save. Typically 10% for 30 years is kind of the gold standard. So what we recommend, though, is that you just get started with something, whatever that something is, and then try to build from that every year by 1%. So you may say, well, what could 1% really mean? How could 1% really be a big deal? 1% is actually a really big deal when you look at the power of doing it every year over time. If you made $17 an hour and decided you were going to do 1% more than what you did the year before, that would be an extra $6.80 going into your 401k. After taxes, though, you would only have been missing $5.44. And then if you hadn't maxed out the match, there's the match there, and that would be an extra $9.80 going into your 401k. It's an extra $477 a year. And after 10 years, that could have been worth over $6,500, over 20 years, over $19,000, and over 30 years, over $45,000. The lifestyle factor, we talk about the fact that there's a lot of competition for your paycheck, and we understand that. But if you could just think of one thing that maybe you could do a little less of every month, that you could either begin contributing to your 401k or go up by 1% more, we know that it would be a very big deal for you and your success rate. So another form that you should have received with this PowerPoint was contribution change forms. So if you would like to change your contribution, I'm going to encourage you to do that today. You can submit that right to Heather, and she'll get that submitted for you. Everyone has the opportunity to change. If you're not sure what you're contributing, reach out to Heather, and she'll let you know what your contribution rate currently is. And again, the only way for you to increase your percentage of success is to continually increase what you're contributing. If you have questions about trying to determine other contribution rates, I can help you figure that out. You can give me a call at the office. I'd be happy to walk you through that. In the next couple of slides, we're just going to talk about mutual funds and how we invest your accounts. So the different mutual funds that we choose are according to different asset classes. And so you can see all of the different types of asset classes that we invest in within the 401k, stocks within the U.S., outside the U.S., and then different bonds. Mutual funds are diversified. One mutual fund may own up to 100 of individual company stocks. So if one company has a bad year, you have 99 other companies in that same fund to help offset that. You also don't have to put your money all in one asset class. Typically, we would recommend that you would spread your money out through the different asset classes so that if one asset class has a down period, you have all the other asset classes to help diversify from that. First investment option that there is cash. With cash, your dollar is always worth a dollar. So your reward is stability of principal. You can never lose any money. Risks are inflation, that you'll never earn enough to keep pace with inflation and what your needs will be in the future. Examples of cash would be CDs, Treasury bills, and then we have a fund called the MetLife Stable Value, which currently the yield is about 2.8% guaranteed for the next 90 days. Every 90 days they release a new yield. That yield might not sound that exciting to you, but when you think about what money market funds are yielding, that's actually a pretty competitive fund option. Bonds over the long run have outperformed cash, but they're not guaranteed. So with bonds, you will at times see ups and downs in your account. One of the risks of bonds is changing interest rates. When interest rates go up, the value of some bonds will temporarily go down. Stocks over the long run have had the highest potential returns. They're also the most volatile. So when you have an account with stocks, you will see ups and downs in your account. Examples of stocks would be large company, international company, and small company. And then this is just a chart that shows you that top line there would be small cap stocks. And you can see there's definitely been periods of volatility, but over time it has steadily grown. That bottom line is inflation. And then you can see Treasury bills, which would be cash, and then bonds above that. So what if you were going to invest $2,000 a year in a portfolio that was 50% stocks, 25% bonds, and 25% cash? That would have given us a weighted return of about 7.2%. Over 10 years, that could have been worth $32,000. Over 20 years, that could have been worth $112,000. Over 30 years, that could have been worth $327,000. Every quarter, every fund that we offer is screened according to these 9 criteria very extensively. So we don't just choose a fund and then leave it there and never look at it again. Every quarter, we're screening funds to make sure that they remain appropriate. Dollar cost averaging is an example of how you can actually benefit in a down market. So if in January you decided that you were going to invest $100 a month regardless of what happened in the market, January you would have been able to purchase 3.3 shares. And then in February, let's say you decide you were still contributing your $100 a month, but that same mutual fund was now worth $25 a share. Well, that month you would have been able to purchase 4 shares. Now let's look down to May. In May, we were in the middle of a major market correction. That same mutual fund that we were paying $30 a share, right now we can get for $10 a share, and so we were able to purchase 10 shares. And so it's almost like every now and then the market goes on sale for us. And so it's important to remember that there are going to be ups and downs in the market, and I know we've been in a period where the market is just continuing to climb, but that can't happen forever. So eventually, if the market does have a correction, if you can remember that as long as you don't sell your account, you don't sell to cash, because that's how you lock in those losses, if you continue to contribute to your 401k, then you're actually able to buy these shares on sale. And again, if there's ever an issue in the market and you're having concerns, please don't ever be afraid to give me a call at the office so we can talk about that. We're always happy to do that. That's part of the reason why we're here, is to provide servicing for you. Determining what your appropriate risk profile is determined based upon your time horizon, your personal risk tolerance, and what your goals are. Do you think that you're ahead for retirement, on track, or are you behind? We try to make it very simple for you to invest in models, and so we have 5 investment models based upon 5 investor types. Model 1 is our most conservative. Model 2 is our moderate conservative. Model 3 is our moderate. Model 4 is our moderately aggressive. And then Model 5 is our aggressive model. And if I knew nothing else about you but when you were planning on retiring, that would give me a good idea about what a good model might be. If you're within 5 years, maybe Model 1. 5 to 10 years, maybe Model 2. 10 to 20 years, maybe Model 3. 20 to 30 years, maybe Model 4. And then over 30 years, maybe Model 5. And then here's our 5 models, and then just the breakdown of what funds and what percentage are there. And the one comment that I'll make is that you see a lot of Vanguard funds here. That wasn't done necessarily on purpose, but just with our fund screening, Vanguard consistently came out on top when we looked at what our strategy is, which is consistent long-term performance at very low cost. And one of the comments that I'll also make about this is you'll see that the share classes that we're able to offer our participants are the same share classes that billion-dollar 401k plans have. We're able to get retail share classes based upon the volume that we do with Vanguard. And so we feel very comfortable saying that we are able to offer you a 401k that's as good as the best-run Fortune 500 company. And then this is just performance data as of the end of March for 1, 3, and 5 year. And as you can see, we have a lot of double-digit returns in some of the different funds. We don't want to expect double-digit returns. That's not realistic over the long run, but obviously we will take it when we can get it. And then also, this is just our model. So Model 1 through Model 5, this is what the returns were for both 2017 and 2016. And then target date funds. Target date funds are just as they sound. You choose your targeted date of retirement, and then it will automatically go from more aggressive to more conservative the closer you get to retirement. As a note, if you are enrolled in the 401k, auto-enrolled, and you do not choose a model, you are automatically going to be put in a target date fund and not a model. So I encourage you that if you're either newly eligible or you believe you're auto-enrolled and you never actually spoke with me, I would love to have a 10-minute conversation with you to help you decide if a model would be better than just being in a target date fund. Target date funds are completely appropriate. They are a fine choice. The only reason why I say that sometimes the models are a better idea, the target date funds will not take into account if you're on track or if you're behind for retirement. It's going to put you in with every other American who's slated to retire on that date. So if you sometimes then the model, we can be a little more custom with that. But If you have questions, again, please give me a call. And then this is just the investment data of the target date funds. So every now and then we make fund changes. We don't make them very often. Today we're going to talk about a few. Number one, anytime we make a fund change, it doesn't cost you any money and it never makes us any money. We're doing it because we believe it's in the best interest of your account. So target our fund changes that we're going to discuss today, and you also receive your 30-day fund change memo. You should have received that with the other paperwork that you were given. Number one, we are changing our target date lineup from American funds and Vanguard to just Vanguard funds in the target date lineup. We really felt like it made sense that we should have one fund family so that as you go from one 5-year bracket to the next, the investment philosophy should be the same, not going back and forth between what different companies do. And when we did our fund screening, Vanguard consistently came out on top when we looked at performance, what the different mixture of bonds versus stocks were, as well as costs. The second fund change you're getting a notification for with the MetLife Stable Value, we were able to find there's another share class of the same MetLife Stable Value with a little bit of a higher yield, which means that it gives a little higher return than what the previous share class had done. And so we think anytime we can help you find, a little more return, we think that's a good thing. So we're going to be exchanging share classes of the MetLife Stable Value funds. So today you should have your 30-day notice, and if you're okay with, if you have balances in any of the funds that are being replaced and you're okay with just moving over to the new fund, you don't have to do anything. If you don't want to move to the new fund, you have to move your money out before the deadline that's listed. Regarding expenses, we give you line item deductions right on your statement so that you can see who you're paying and what you're paying. We think transparency is important, but every now and then I'll have an employee who will call me and say, hey, I've never seen deductions. I don't understand why I'm paying. And so typically that means that all of their expenses were bundled into their fund expense ratio. So it came right off of performance. So if their fees were 1.5% and performance was 10, they only saw 8.5% performance and never actually saw any fees, but they paid for it. And so we just think it's important for you to be able to see what you're paying and who you're paying it to. Last couple slides, FIS is the new retirement readiness that we're going to be able to offer you. You're going to be able to see some retirement readiness data right on your statement. Here you'll be able to see what your projected retirement income will be based upon what you're currently deferring, and then as well as what you probably will need based upon your income and your age. And so the only way to fix that if you're not happy with what that number is to increase your deferral rate. So we're excited for you to be able to start using this. We'll talk about it more at group education throughout the year. There's also an online portal through FIS, which is tied right to Turning Point's website. So it'll begin to give you some projections on what you're going to need versus how close you are to actually doing that. And this part right here, improving your retirement projection, is probably the most important part of this. So if you want to figure out how you can change your income projections, you use this toggle screen to go up or down and show you, how much more you need to be contributing a month. And if you can't do, you might say, wow, I need to do another $600 a month. I can't do that right off the bat. That's fine, but maybe you can do an extra $100 a month, and then you can try to build every quarter until you get up to where you need to be. There's also an extended tool set up. You can add in spousal assets. You can put in the assumptions of how you're currently invested versus how you'll be invested in retirement. You can start to see your probability of being able to withdraw certain percentages of income for life, which can be really powerful for someone getting ready to retire. And then there's some budgeting tools here as well. So really neat software, all tied into Turning Point Associates, so you don't have to go to a new website. That'll be going live soon for you. If you have questions, please give me a call, and I can help you walk through that. Last couple slides here. If you are retiring, your options, if you have more than $5,000, you can keep it in the plan at Regal, although typically it makes more sense for you to roll it out into an IRA Anytime you do a rollover, there's never any tax implications. Or you could receive a taxable lump distribution, which usually is not the best course of action, but it's an option. Regarding retirement and planning and financial planning workshops, I'm actually going to be starting to hold webinars where you will get information regarding the topics that I'll be talking about. You'll have the option to either sit in live or to come back and watch a pre-recorded webinar that we will host on our website for you. If you have thoughts about what you would like to have me present, I would be really open because I'm hoping that participants will utilize it and will come to us. If you have questions today about whether or not you're eligible or what you're currently contributing, you would reach out to Heather. If you have questions about servicing at Turning Point, if you want to change your beneficiary or you're not sure what model you're in or you're having trouble logging into your account, this is Turning Point Associates information. And then this is information on how you can log on. If you got locked out of your account, it happens all the time. Don't worry about it. Just reach out to Turning Point. They'll reset your account for you. And then this is our information here at Victory. We're a local company. We're located in Gloucester County, New Jersey. And so this is our toll-free number, as my extension, as well as Bud's. And so anytime you have questions about how you are invested or increasing your contributions, or you just have questions about the market or what's going on, we would greatly encourage you just to give us a call and allow us to help you with that. So I hope today was helpful. Thank you so much for tuning in, and we look forward to working with you soon. Have a great day.